Hi, welcome back to today's RIA Pro podcast. I'm your host, Lance Roberts, with Michael Lebowitz, CFA, Portfolio Manager for RIA Pro. Mike, we just left off talking about this chart, looking at volatility versus yields and what that means potentially for this current cycle. But you've got some more charts to go through here talking about this cycle. So where do we go to from here?
So we showed the bird chart, and that can be confusing. I get it. And it doesn't necessarily show the cycle directly. So I thought I'd put together a few other charts that just show exactly what these cycles look like, but also give you context for where we are. My next graph or set of graphs I want to show you is about the employment cycles. And employment is very predictable. It goes down, stops, it goes up. It doesn't linger. It's either going down or it goes up. And every time it goes down, it reaches a point, and a recession follows almost imminently once it starts rising beyond 0.5%. Mm-hmm. And on the graph, you could see there's about 9 recessions or 10 recessions that unemployment went down to decently low levels and then popped higher. If you look all the way to the right, you could see where we are currently. We're at a very low unemployment rate, and we haven't necessarily popped higher to call a recession imminent, but you get the picture. This is how cycles work.
Well, I think it's important here to understand is that whether it's employment or confidence or the markets or anything else, people talk about, hey, it's a record, right? We got record low unemployment. Well, records of anything are records for a reason, because that's where the last cycle ended, whatever it was. So just by its very nature, when somebody starts talking about record low unemployment, that's probably the time that we want to say, look, this is probably as good as things you're going to get. Bull markets for investors, bull markets are not born out of everything being positive. Bull markets are born out of extreme pessimism. Bear markets are born out of extreme optimism. And that's the one thing I think investors miss.
Right. And what we have to ask ourselves, too, is can unemployment go lower? The answer is yes. But if you look at the smaller graph to the right, mm-hmm. you can see that the unemployment rate versus the 10-year moving average is the lowest it's ever been since at least 1958. So we are in uncharted territory as far as unemployment rate goes. So, yes, it can go lower, but the odds are saying something very different.
It's an interesting point here as well, and something that we've talked about in the past, but, we talk about the unemployment rate here, and this is unemployment relative to the labor force participation, right? So you take a look at the labor force, how many people are in the labor force, and how many of those people that are eligible to be in the labor force are actually unemployed. So we're currently looking at a period in time where 96% of the people of the labor force are employed. That's great. But the labor force participation rate remains an extremely low level. It's never really recovered from the financial crisis, still remains very low. One of the questions that I think that, we have to consider is during the next recessionary cycle, we may not see a massive spike in unemployment, but still have a pretty meaningful recession simply because in this cycle, we never saw the labor force participation rate really expand.
That's a great point, Lance. And we also have 2 recent articles on employment and showing you some other indicators that show that the very low unemployment and jobless claims rate mm-hmm. may not be nearly as great as everyone thinks it is. So go take a look at those as well. Next up is the yield curve cycle. And it's not as clearly defined as the employment graph I just showed you, but when you look, you can see some similar trends occur. The yield curve goes up, it goes down, it goes up, it goes down. But if you notice at the troughs, which are circled red, there's a recession that follows. I'm not going to use the word imminent, but within a year and a half, sometime sooner. And once again, looking all the way to the right, we're getting pretty close to that zero line, which says that the 2-year rate is above the 10-year rate. So let's move on to the consumer now. That's you and me. We represent 70% of GDP. So that's where economic growth will come from, or where a recession will come from. How much are we spending? Are we tightening up? Are we spending more? Are we in a good mood, a bad mood? And this next graph by Jeff Gunlock at Double Line Funds is great, and it shows the cycle so clearly. What it shows is, in red, those are the expansionary periods. And as an expansion goes on, the consumer at first starts feeling great about the future. In fact, the feelings about the future are much, much better than their current situation. But as time goes on, they start worrying more about the future, but the current situation remains okay. And as you can see in the graph, this cycle plays out, and currently we're at very low levels, meaning that the consumer is very concerned about the future, whereas the current situation remains okay. The difference is what matters. And what's stunning about this is when the red bars reverse, when they start going higher, again, recession is imminent, but the surge happens incredibly quickly till we get to the point where they are once again feeling better about the future and not so good about the present period. So to this point, we've shown you a few different cycles, market cycles, economic cycles, but let's just look at the GDP cycles, the economic expansions. The graph that we're showing has every economic expansion as far as duration in months going back all the way to 1857. And the current expansion in orange all the way to the right, you could see, is actually 1 month from being the longest expansion in history. Again, going all the way back to before the Civil War. So this keeps leading us to the same point. Can we keep expanding? Absolutely. Is history on our side? Absolutely not. And that's what matters here. We don't have a crystal ball, but what we do have is the ability to compute odds and understand that the odds are in our favor or against us. And that's how we have to progress.
So, one, as investors and as individuals, and as we talk about, managing money and market cycles and these type of things, it's interesting that the mainstream media, for the most part, and again, you can go onto any financial media website right now, and you will find tons of articles about why the yield curve doesn't matter, why you should just remain invested, why you shouldn't be concerned about these things. But the reality is that history is very clear about what happens in these cycles. And again, when we go back and look at yield curve inversions in particular, they have a very clear track record of suggesting that there's something amiss within the economy. And I think you have to match that up here with the Federal Reserve's recent actions. In October of last year, the Federal Reserve, Jerome Powell, chairman of the Federal Reserve, says, hey, we're a long way from the neutral rate. We're going to keep hiking rates 3 more times next year. Our balance sheet reduction is on autopilot. 3 months later, the markets declined by roughly 15%, and all of a sudden there's a complete reversal in Fed policy. Now, no longer are we going to hike rates. There's actually a 60% chance we may cut rates by the end of 2019, and more importantly, the balance sheet reduction is going to be stopped in September. The important point here, I think, that investors have to pay attention to is that the Federal Reserve is clearly seeing a problem that the mainstream media isn't yet caught onto. Would you agree with that assessment?
Absolutely. And it's just another point of evidence. We've shown a bunch of evidence that the cycle's coming to a close, and the Fed is just confirming that in spades. And that to me makes me feel much more comfortable that we are in the bottom of the ninth, and there are possibly 1 or 2 outs. From an investment point of view, this is the hardest part. It's when the cycles turn. Right now, it's very hard to be conservative when all your neighbors are making a lot of money in the market and the financial media is screaming, you got to own stocks, you got to keep making money. Conversely, when you go back and look at March of 2009, anyone that was buying stocks then, people thought were crazy. And in reality, those people were the ones that did the best. So it's really hard when you get to these cycle turns, when you get to the beak and when you get to the tail, to do what everyone else is not doing. I think it's best to conclude with another quote from Howard Marks. It goes as follows. Invariably, investors who disregard where they stand in cycles are bound to suffer serious consequences. In other words, understand what inning we're in and take actions that are appropriate for that part of the cycle, not based on what the financial media or your neighbors are telling you.
And that wraps up our RIA Pro podcast for today. I'm your host, Lance Roberts. Michael Lebowitz, CFA, co-portfolio manager for RIA Pro. Of course, you can get this podcast as well as all of our articles and blogs at the website riapro.net. And of course, as always, we'll be bringing you new content all the time. So make sure you stay tuned to what's going on here at riapro.net.
It's a rich man's